Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 427 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about something very interesting that's been going on in financial markets, and specifically with one company. And just on the front end, this is not an indictment of this particular company. This is just a company that I actually use. And so I was really interested in knowing what was going on with this investment company and their investors. So we're going to talk about a lot of things from taxes to target date retirement funds and what you should trust, what you shouldn't, all those types of things in today's episode. And hopefully you can become a more knowledgeable investor and understand some of the things that are going on behind the scenes at some of these larger investment institutions, and just get a better feel for what you should think about certain financial products. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, I ran across this article this past week that I thought was intriguing, to say the least, right? Vanguard is a company that I use for some of my investment accounts, and ran across something that I had no idea about with Vanguard. And so I wanted to read a little deeper, and then I wanted to let you guys know about it, and then we can talk a little bit more about the ins and outs. And the title of the article was Vanguard Created Big Tax Bills for Target Date Fund Investors Lawsuit Claims. So a bunch of big key words there, right? First of all, Vanguard, which is one of the largest asset managers in the world. Then big tax bills, right? That's bound to get anybody's attention. Target date funds, which some of you may know what those are, some of you don't. I'll explain that in today's episode. And then obviously lawsuit claims. So a lawsuit being filed against Vanguard, which is a very big deal, right? So we'll go through this article. I'll stop and explain some things to you, exactly how certain things work. And you can get a better idea as to what's going on here. And I'll give you some thoughts, right? What do I think about this particular situation? So Vanguard Group and its executives created big tax bills for some investors in its target date funds, amounting to hundreds of millions of dollars in aggregate, according to a lawsuit filed last Monday. The lawsuit filed in Pennsylvania federal court by 3 investors claims the investment manager triggered, quote, an elephant stampede sell-off in its target date funds. Now, the sell-off ultimately led to, quote, enormous tax bills in 2021 for people who own the funds in a taxable brokerage account instead of a tax-advantaged one like a 401k plan, an IRA, the lawsuit alleges. Now, let's just stop right here. There's a couple things I want to talk about, and then we can move ahead. First of all, do any of you know why this would be only for brokerage accounts and not for tax-advantaged accounts like 401ks or IRAs? Well, because with a 401k or IRA, regardless of if it is Roth or traditional, you are not paying taxes on gains within those accounts, right? So if you owned one of these funds within those accounts and there was some realized gain on which you were to pay taxes, you wouldn't, right? You wouldn't, because it was in a tax-advantaged account. Whereas if it's in a taxable brokerage account, there are tax implications to realized gains. Now, obviously, when you have a taxable brokerage account, you buy something for some price, right? And whatever that thing may be, right, you hold it for some period of time, and then when you sell it and you sell it, let's say, assuming you sell it at a gain, you must pay taxes on whatever the difference is in the price that you paid and the price that you sold that asset for, right? So that's the simple idea of, capital gains and having to pay taxes on your capital gains. Now, obviously, if it's, within a year that process happens, then you pay your ordinary income tax rate on the gains. If it's greater than a year over which time that happens, then you will pay the capital gains tax rate, which can range from 0% if you make under a certain amount of money, and then up to 20% on those gains. So I would guess here, before we even dig deeper, right, that these big tax bills are some realized gains, right? It must be some realized gains. And I think the issue probably is the fact that we're talking about target date retirement funds. Now, that pushes me into, well, what in the world is a target date fund? And we call them target date retirement funds a lot of times because what people traditionally have done is they find a fund that has some date that is around the time when they think that they'll want to retire, and they just buy that fund and buy that fund and buy that fund. And that seems to be a pretty good idea for a lot of people because what these target date funds do is they will start you off, let's say very early on. I'm 26 years old. Let me just go to Vanguard, right? So we'll go to Vanguard and we'll look at their target date fund. So we'll go to Vanguard. I'll go personal investors. I'll walk you guys through this as to how to actually get there. So if you don't have an account, I think you can still do this. And so I will log in here, and then you can go and look at the top, and you can say, okay, well, what do they offer? It says what we offer. So we can go to mutual funds, okay? And so you can browse an entire list of Vanguard mutual funds. And so that is what I want to do. So we'll look at this whole list, right? And there's all types of strategies, all types of ideas, but what we want to look at is the target date funds. So for instance, for someone like myself who's 26 years old, let's say that I wanted to retire at age 65, right? So I turned 26 last year. Last year's 2021, right? So in 2020, I turned 25, let's say at 65. So that would be in 2060. It seems like a long time from now. I'm sure it will sneak up on me, right? And lo and behold, Vanguard has a Target Retirement 2060 fund. Okay, VTTSX is the ticker. So I'll click on that, right? And just see what is in this fund, what this fund is actually doing. So right now, this particular fund is 88.85% stocks, 9.69% bonds, and 1.46% short-term reserves. Okay, and so typically that stock allocation is going to be some underlying fund. And so we see here the total stock market index fund is there, and then an international stock fund is there, and then they hold bond indexes as well for the bond allocation. Now, that allocation is going to change over time, right? That allocation is going to shift from approximately 89% stocks all the way down to about 10% stocks over a long period of time. And so it's just going to keep decreasing in risk as you get closer and closer to that ultimate retirement date, that 2060 date. And so over time, what will happen is whoever's managing the fund will continue to decrease your risk as you get closer and closer to that date. And that makes sense because when you get real close to retirement, you want to make sure you actually have money in retirement. Now, many, including myself, would argue that they take way too much risk off the table, right? That they get you far too conservative towards retirement. But if you just want some way to invest all in one, which is why it's under the all-in-one category on Vanguard's site, then this could be a very good option. And they're low cost, especially with something like Vanguard. This one has an expense ratio of 0.08%. It only takes $1,000 to start investing in it. And so it's typically a very good option for those who don't want to think about investing too much and just want to pick one fund that they can put money in. again, you could argue against it. I would probably even argue against it, but that's what it is. And so obviously, if you're older than me and you pick a fund that's closer to today, your allocation may be less stocks and more bonds. If you're younger than me, I think the largest allocation they actually put towards stocks is around 90%. So you don't get far more if, let's say you're 20, 21 years old. I don't think you get far more in the way of stocks there. But this whole idea is that they hold these funds, they have these funds within the accounts, and then they change the allocations over time. Now, what's interesting is, how does that create enormous tax bills? How does that create enormous gains? Well, first off, any gains within a mutual fund that are realized, right? So you may say, okay, well, I bought the mutual fund here and maybe I sell it here, then my realized gain is what I made, right? Well, yes, but that's not everything, right? Whenever you hold specific mutual funds, or you have a target date fund, which is what's called a fund of funds because it holds specific mutual funds within it, right? We talked about a total stock market fund, those bond indexes, things like that. The gains that are realized by the managers within those funds, right, as they reallocate, as they buy and sell things within the fund, turn into distributions to the investor, right? And that becomes taxable to said investor if held within a taxable brokerage account. Okay, so that might be what's going on here, but let us read on. Now that we got some things out of the way, you understand capital gain situation. Hopefully you understand target date funds. You can look up more things on that. Now it says Vanguard, as well as executives and fund trustees, therefore violated their legal duties to investors, the lawsuit claims. The plaintiffs, and I'm just going to leave their names out for my sake, but the plaintiffs seek compensation for the alleged harm on behalf of a class of similarly situated investors nationwide. A Vanguard spokesperson declined to comment on the lawsuit, but the heart of the legal claim stems from two types of target date mutual funds Vanguard makes available to retail and 401k plan investors. These are funds designated to get more conservative over time, just as we just spoke about, right? Now the lawsuit also concerns asset location, right? So this is a financial planning principle where certain types of assets are better held in tax-advantaged accounts to avoid surprise tax bill. The two Vanguard Target Retirement Fund suites had the same investment strategy, but investors needed at least $100 million to access the lowest cost version of the mutual funds before December 2020. That month, Vanguard reduced the threshold to $5 million, fueling an exodus from the higher cost version. That flight of money caused Vanguard to sell as much as 15% of the assets in the higher cost retail funds. And Vanguard needed to sell fund assets to raise cash to redeem shares for investors, the suit claims. Now, this goes to the very heart of what I was just talking about with mutual funds, right? So mutual funds and ETFs for that matter, we're not even going to get into ETFs today, but mutual funds can have inflows and outflows, right? And outflows are going to trigger exactly this. Outflows are going to trigger taxable events for investors. Now, typically, you see a lot of outflows when things are performing in a negative manner. So it would just make sense, right? It would just make sense that if things are performing in a negative manner, people would fly out of there. But the taxable situation that creates is actually some tax loss harvesting in most cases, right? So you would see people actually benefit from the fact that they have some tax losses within that particular fund that they own. But if you've been in a situation where there's been a bull market, you've held that fund for a while, there's been some longer term gains, and then you see a bunch of people fly out, right? So it says Vanguard had to sell as much as 15% of the assets in one of the higher cost retail funds. Well, 15% of assets doesn't sound like a ton, but if you know Vanguard and you know the size and the scope of Vanguard and the fact that they have mutual funds with billions and billions of dollars in them, this is a lot of money, right? And this is a lot of money that will turn into taxable gains for investors. And that can become a very big problem, as they argued it did here, right? So if something like this were to occur, so let's say that you're holding the lower cost version. Okay, if you're holding the lower cost version, nothing is really going to occur for you, right? Because all of the flows are inflows. And so what's happening is they are just readjusting what's going on within the portfolio, doing a lot of buying, right? And buying is not going to trigger capital gains. Only the selling will trigger capital gains tax situations, right? But if you were holding the higher cost version, right, you're a retail investor, you're holding a higher cost version because you don't have the amount of assets to be in the lower cost version, then you'll end up in a situation where they did a bunch of selling within a mutual fund that you just sat there and held. You didn't sell through, you just held it, right? And they had to redeem the shares for investors. They had to do it. They had to take those investor trades and change them and put them in the other fund that they were asking to be put into, right? But that creates big tax gains for people who did not actually sell those funds. Now, the argument here and the presumed reason that a bunch of people are frustrated and that there's a lawsuit on the table is because this is all happening in response to something that Vanguard put into place, right? They went from saying that investors needed $100 million to access the lowest cost version of these funds to saying, oh, you only need 5. Well, the difference between somebody with $100 million to put in a fund and $5 million to put in a fund is a vast difference, right? So the number of people that can put money into a fund, if it's dropped to 5 million, is far greater than if it's at 100 million, right? So this is based on their own policy, which is probably the basis for the lawsuit. Now, generally, when a mutual fund sells its assets for a profit, it results in a distribution of capital gains to the shareholders, right? Investors who own the funds in taxable accounts pay taxes on those capital gains. Conversely, those who own them in 401k plans, IRAs, and other tax-advantaged accounts can reinvest the gains without a tax bill, right? So if you were somebody within a 401k and you held one of these funds that had the lower cost, again, that wouldn't have impacted you. But even if you held the higher cost fund and continued to hold the higher cost fund, then you would have been unimpacted, right? There would be no impact to you. But to all of those people who held it within a brokerage account, a taxable brokerage account, there would be a taxable gain to deal with. Now, why would you hold something like a target date fund within a taxable brokerage account? Well, typically, the idea would be, okay, we're going to hold something that is low turnover as far as mutual funds or ETFs go within your taxable accounts, right? Because this exact reason, right? Because if something is high turnover, then it can trigger a lot of capital gains, and that will turn into tax bills for an investor. But if you hold something that is low turnover, then you can avoid taxes there. That's why people put a lot of growth-oriented things, in many cases also income-oriented things, within their IRAs, because the dividends that are paid within an IRA, there's not going to be any taxes on those dividends. They're just going to be reinvested, and then any realized gains within a mutual fund, an ETF, whatever, will just also be reinvested within an IRA, 401k, any of those tax advantaged accounts, right? So people try to hold low turnover things, but some people didn't think that this type of thing would occur, right? This has traditionally been a low turnover mechanism, right? This idea that we're putting money into a target date fund, right? We're saying, okay, the allocation is not going to change wildly, right? It's going to change very gradually. You're putting money into these indexes, these underlying index funds within this target date fund. The money shouldn't, trigger any major gains, but they did not foresee something like this happening. Now, in this case, investors in the higher cost funds got distributed at least 40 times larger than previous years, right? So there's an expectation every year that there's going to be some type of distribution, some type of, selling that's done in order to rebalance or whatever that may trigger some small gains. But in this case, distributions were 40 times larger than previous years, according to the lawsuit. And the plaintiffs incurred estimated 2021 tax bills ranging from roughly $9,000 to $36,000. Now, again, in the grand scheme of things, if we're talking about somebody with millions of dollars, a $9,000 tax bill is not crazy, right? But if you're talking about somebody with a few $100,000 and they get a $9,000 tax bill, that's going to be quite frustrating, right? So I would generally understand why these plaintiffs are, saying this and why they're saying that Vanguard caused the damages. Now, I'm not agreeing or disagreeing with the lawsuit. All I'm saying is that it was based on a policy that Vanguard put forward. Now, whether or not that policy is their right, that's probably a whole nother question, right? Can they set this type of policy? But this really makes me think, as an investor, do I have any type of funds that are in a location that potentially they could be harmful to me, right? And I think anytime you're sitting with, and this is telling based on this particular case, but anytime you're sitting with a fund that has different tiers, right, has tiers of cost based on the amount that you can invest, and anytime that those tiers may change, that can cause something like this to happen, right? So regardless of what type of fund you hold, whether it's a S&P 500 fund that you expect to be low turnover or a total stock market fund that you expect to be very low turnover, anytime there's some type of tiered system, it seems like this type of thing could 100% occur. Now, again, if you hold those types of things in an IRA, a 401k, or whatever, there's no reason to worry, right? Because the underlying investment is the same, and then you don't have to deal with the capital gains associated, right? But if you're trying to decide what to put into a taxable brokerage account, then these may not be the best idea. Not just target date funds, but any type of fund that has these restrictions, these thresholds, as far as how much money you can put in and what you pay in fees based on the amount of money that you have under management. So what type of ways could we go about keeping this from happening to ourselves? I think one perfectly good idea, it would be ETFs, right? So all of these target date retirement funds are mutual funds, okay? And mutual funds pass on these gains within the fund to investors. With ETFs, this is not going to typically be the case. Okay, with ETFs, the buying and selling that may be done within the fund is not going to be passed on to investors. You're just strictly going to pay capital gains on the difference between what you bought something for and what you ultimately sold it for, not the buying and selling that's done within the fund itself, right? So that's something that gives you some tax efficiency and can allow you, in many cases, to just be invested in the same things, but do so via ETFs. So if you were trying to do something target date wise, I would suggest, especially with something like Vanguard, you would just create the target date yourself, right? You would say, okay, I'm just going to hold an allocation of, let's say the entire 90% of stocks was the total stock market index. Well, I know the VTI is the ETF that Vanguard has for the total stock market, right? So I could buy, 90% of my funds, have them buying the VTI, and then if the rest were just a typical bond index like BND, well, maybe the 10% buy BND and done, right? So it could be something as simple as that. You could just recreate it with ETFs yourself, maybe a very good idea. But you could also just think about, using some individual investments within taxable accounts. I don't necessarily recommend that. I think ETFs are just going to be the most useful and tax efficient way to invest in taxable brokerage accounts. I would also suggest, and this would be a very good argument for actually taking advantage of tax advantage accounts. A lot of people choose not to take advantage of tax advantage accounts, even though they could, because they're like, well, what if I want this money before I'm 59 and a half, or, whatever, right? Whatever reasoning they may give. And the truth of the matter is that there are ways that you can get your money before 59 and a half, right? For instance, Roth IRAs, you put money away in them, you can get your contributions out at any time, and you can get earnings after 5 years. That's a whole different episode, whole different story. But if you're not already taking advantage of tax advantage accounts, then do so. And then you won't have to worry about, recreating a target date fund or whatever. You can just buy these target date funds and there should not be any type of issue. Things like this are not typically things that we think about as investors, right? We're thinking about asset allocation, sure. We're thinking about, our risk profile, sure. We're thinking about, how long we have to invest, sure, right? But rarely do we actually think about what the implications would be of, some change in minimum threshold for some fee structure. I mean, that doesn't cross the vast majority of investors' minds. Truly, never crossed mine until I read this article. So this is very interesting to me, and I think it creates some real questions as to what we should be invested in taxable accounts. I think it may lead some people to not trust target date funds, obviously, within these taxable accounts, and really make people question if this idea of tiered fee structures is actually the right way to go for these investment companies. Maybe they get pushed to this idea where everybody pays the same, or where once you set some threshold, you can't just change it arbitrarily and make that, trigger some major capital gains over time. So again, very interesting, something that we should keep in mind, and maybe something that you should think about when it comes to your own investment accounts. And maybe you're one of these people who actually got a tax bill because of what happened with these particular funds. And if so, maybe you didn't know why, maybe now you know why. But I'll say this doesn't make me necessarily lose trust in Vanguard. This is one of the best investment companies there is out there. One of the largest, manages tons and tons of assets. Not going to move my money from Vanguard just because of this, but I'm going to be a little more thoughtful about where I put my taxable money because of this, and I think that you should too. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. That's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning in to this episode of Money's No Object. I'm your host, Dylan Howell. God bless.